Okay, welcome guys. This is another video that will be explaining what fair value gap is all about. So I'll be I'll try my best to make it simple as much as I can. So let's dive into it. I have few diagrams in front of me. So the first one uh, illustrates when fair value gap is in upside. Okay, let me change this color. Then the second one, which I'm changing the color, illustrates how to identify fair value gap in the downside when the market is bearish. So, so as you can see, fair value gap is the gap between three consecutive candles. So if you are to look for fair value gap, let's use this as an example. This is the first candle, this is the second candle, and this is the third candle. The gap between the three candles, the first and the third candle, let me say this is the first, the gap between this and this is what we call fair value gap. So in a situation that we have the market moving up like this, weak is considered, body is also considered. Let's say this happens like this, is considered. But the gap between them, if there is gap, is what we call fair value gap. So let me remove this. So as you can see, in a situation that you have a candle that prints the first one, then the next candle print the second one, you can see there is no gap between this candle and this candle. So this is not what we are looking for. So we are waiting for the next candle to open and see if there will be gap. So you can see that I will mark this. This is the end of this first candle. Then look at the where this third candle stopped, which is this one, like this. So it means the gap between here and this level is what we call fair value gap. So that's why people we say okay, they are waiting for their entry at fair value gap. Some people we actually put their entry like this if they are using fair value gap entry, because they expect the market to come and fill this gap. So they believe there is still remain order here that is not yet filled. So they expect the market to come and fill the gap. So that's what fair value gap is all about. Market can, for example, market can we can have a situation whereby market we print another candle like this. We print another candle like this and continue. No matter how many candle the market prints upside, this still remain a fair value gap the market is likely to come back to in the future. So this is what fair value gap is: the distance between the three candle, the first and the third candle that move consecutively. So in the same direction, whether the color of the candle doesn't matter. This can be red, this can be green, it doesn't matter. So what matter is the candle, and you check the first one, the second one, and you look for the gap in between them. So let's say this one also happened like this, for example, like this, and then market push up, create another candle. You can see that we have the end of this candle. So it means that we'll be working with this second candle like this, and this third candle like this. So the gap in between them is still a fair value gap. So it means the market have left two fair value gap behind. So that's what fair value gap is talking about in this particular drawing. So you can see the other side of it is when the fair value gap is unmitigated. The same example here, you can see the first candle, the second candle, and the third candle. So this is the first, the second, and the third. So the gap between the first and the third is what fair value gap is all about. So as long as there is gap, it means that there is fair value gap. Assuming that this happens like this and you can see there is no gap, it means that this this movement has no fair value gap. All the order has been filled, all the space has been filled. So no fair value gap. So there is no tendency that the market is going to come back to any fair value gap or not. So, and this fair value gap is very, very important, because if you're choosing an order block without fair value gap, then it's likely you are setting yourself up. So valid fair value order block must have fair value gap. So valid order block is very, very important. It's one of the characteristics of valid order block. So, but in this video, we're not talking about the order block. We're talking about the fair value gap. So maybe in the next video, we'll talk about the order block. So in this situation now, we have a situation whereby market mitigates, come back to mitigate the fair value gap. It's not necessary that market must fill it like this. So if you look at the first, this is the first candle that we are talking about. Then this is the first. Let me label it. This is the first. This is the second. This is the second candle. So, sorry. This is the second candle, like this. Then this is the third. You can see that the first and the second click to each other. There is no gap between them. But the first and the third has a gap. So that's why I put the space to cover up this space here. So this is it. So, but I have to illustrate another situation whereby markets refuse to mitigate this, but later when the market now come back, it mitigate this level. So this mitigation, even if it's like this, even if it's like this, it's still that it's still a fair value gap, because this gap is still there. If you do it like this, it's still there. So there's still a gap, but assuming that we had a situation whereby market closed this gap, it means that all the order has been taken. So maybe when I explain to it on the chart, you will understand. So this gap, even if the market mitigates it this way, it means that there's still a gap in between like this. So, but for the entry sake, people put their entry at this box like this. Then they wait for market to mitigate it, probably put their stop loss and target wherever they want to target. But we are not talking about the entry. We are only identifying the fair value gap. So this is it for this. And if you understand, if you look at this, it's still the same thing. We have first candle, second candle, third candle. You can see the gap between them, and you see that market created another. This is the third candle, created the fourth one, and the fifth one went to go and mitigate that level. As long as market touch this gap and react and move away from it, the mitigation has been done. But it doesn't mean that market cannot come back to the gap that left again in future if necessary, or if market decides to. But for the fact that market has come back and closed this gap like this, mitigate this space, it means that this level has been mitigated and market move away from it. So that's just it for fair value gap. So let me show you on the chart, and probably maybe it will make it more clearer. So if you look at this, let's look at this. Okay, look at this situation now. You can see we have this first candle printed here. This market is going up. Look at this. Okay, let's use this. You can see when market is pushing up, you can see this gap. This first, this is the first candle, second candle, third candle. All there is no gap between them. But if you look at this red one, you see that it's higher than this, and the space in between here, because this will now represent first candle, second candle, and the third candle. The space in between here is what we call fair value gap. So, and probably in future, market might come back to it. I don't know. But if you look at it, market still come and sweep it, mitigate it, and move away. So, and reacted. So, if you look at this one again, in a bearish scenario, this space, this candle, and this candle, you can see the space in between them. This fair value gap, and market did what? Market came back to fill all the gap. So now that it has been filled, then it has been used. There is no need for market to come back there. And you see, after market filled it back, and market pushed down. So that's just what fair value gap is all about. I don't want this video to be too long. For example, look at this. Look at this movement. Look at this gap. There's a gap here, and you see how nicely market fill it, come back and fill the gap and move away. So that's how the whole process will continue. This is just to identify the fair value gap. Another one is here. Look at this first candle. Look at this second candle that printed bearish. Look at this third. So the gap between the first and the what and the third, which is this, that's where market went back and mitigate, and see how nicely the market reacted away from there. So it doesn't mean that market can still not react from this angle, because there is still more gap to fill. In a situation whereby market refuse to fill all the gap, this is still a fair value gap. Whichever way, market will still fill it in future. If you drag it, market will still come back and fill this gap. So completely, it doesn't mean that market will react from there, but at least it will be filled. So that's how fair value gap works. In this situation, let's look for another one. This is another fair value gap. This fair value gap, this one, this is a gap. So because if you look at this is the last selling candle. All this one are inside this candle. So these two candle is still inside this candle. So this is the last selling candle, then followed by this one, then followed by the third one. Then this is the gap. Market went back and filled it. So that's how you identify. Look at this high, look at this low. You can't just be using fair value gap as a strategy. You just have to use it in a specific level. So that's just it. I'm just showing you randomly how fair value gap work. You can see fair value gap. We have the first candle, the second candle, and the third. You see the gap, the market filled it, and boom. So in this situation, if you have your other block here, this fair value gap will make your other block to be valid. So that's why market will tap into it and market will react. So those are that's just all you need to know about fair value gap. And when it's necessary for you to apply it, you apply it correctly. So this is fair value gap. We have a gap between here and here. You can see the way market reacts nicely at this level, push down. So that's just it. I don't want this video to be too long. So this is another fair value gap between here and this third candle. You can see how market came back there, nicely react. So you don't pick fair value gap randomly, but you use fair value gap where you need to use it, where maybe at your POI, at the levels you are looking out, and so when you see fair value gap, that's the potential level that market is likely to come to and mitigate. So that's it for today. If you have any other question regarding to fair value gap, you can let me know. And you have to train your eyes very well, because this is not this easy, most especially when it comes to using it to execute a trade. You have to spend time in front of the screen, be conversant with the chart and so on. So you can't just spot it. It's as a result of long time understanding and seeing the market, the chart moves. That's when you'll be able to spot it this fast. But it's still possible. So you just have to put in the work. So that's it, guys. If you love this video, you have any other question, just feel free to drop it in the comment section. Then I will make a video on it to explain it much better, or any other topic regarding to forex trading, SMC, and so on. So see you again, guys. Bye for now.